Good afternoon, ladies and gentlemen, and welcome to the Van ELLE results presentation. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via vanelle@walbrookpr.com. The company may not be in a position to answer every question it receives during the presentation. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would now like to hand you over to Chief Executive Mark Cutler and Chief Financial Officer Graham Campbell. Gentlemen.
Thank you, Tom. Good afternoon, everyone. We'll get straight into the results presentation. So, a challenging first half of the year, perhaps no surprise to anybody on this call. Most of our markets are suffering from some form of delay or investment constraint. And in the round, we believe we've delivered a pretty resilient set of results because we've got capacity to do so much more. But early signs of improvement in several areas, and we'll come on to that later. But we've already reported in fact, for some time, that housing is already starting to move steadily forward. And before we finish this financial year, we believe we'll be at near capacity in our housing division. We've had several questions about the rail sector, so it's worth just reflecting that the dip between control period 6 and control period 7 was always going to be a challenge for all contractors in the sector. We're no different, but the actions we took to diversify our position in rail, including a major project on the Transpennine route upgrade, has meant that we've come through that relatively unscathed, and we're now seeing growth in rail. Again, I'll touch on that later. And we have contract awards coming through in our growth sectors that started to happen in the period and have continued into the second half and fill us with a lot of confidence going forward. Again, more detail on that towards the end of the presentation. Overall revenue was down slightly, disappointingly. We've right-sized the organisation accordingly because we were not so long ago we're at doing 150 million per annum, and we think we'll go back through that soon enough. But we've downsized anyway, so we're running a lot leaner. Gross margins have held up, and sometimes that affects is around work mix, but also that's a reflection on operational delivery performance. Very rarely do we have a significant operational problem, touch wood. We've got a good team in place, and they've been long-serving and well established in the business now since the changes we made 5 or 6 years ago. And EBITDA is flat, so that's a reflection when you look at our operating profit down slightly and our margins down slightly, a reflection of additional depreciation in the business. Partly due to the acquisition of Albion at the end of the period. Albion Drilling, a leading Scottish specialist piling contractor, fits very well into the group and is already helping us with local presence, local knowledge and relationships, and resourcing for some of the growth opportunities in energy, in particular north of the border. And we've confirmed a 0.4 pence interim dividend.
Okay, thanks, Mark. So I'll just take the usual run through our financials. Very quick summary there of the sectors that we were operating in. 28.1 million, 43% residential. That's a combination of new build housing, so foundations for residential housing, plus an element of that is also the sort of taller schemes, so taller resi buildings as well. In infrastructure, historically, we've had exposure to rail and road, and more recently we've expanded our capabilities and really focused heavily on energy and water sectors, and they're forming a reasonable level of our 40% of total group revenues in the first half. And probably excitingly, those two sectors, residential and infrastructure, are the two areas we see real potential for growth, which Mark will talk to on some of the upcoming slides. In regional construction, a subdued period, only representing 16% of total group revenues, really reflecting some of the challenging conditions that we're seeing out there in the market, the extremely competitive pricing that we're seeing, and a little bit also down to lack of work, partly through some delays to contracts that we've got in our order book. P&L, not a great deal to say here. I think relatively self-explanatory and driven by the 4% reduction in revenue that Mark just touched on there. I think very pleasing to see the margins holding up strongly, and if you were to look back 4 or 5 years, you'll see that that's shown quite a positive progression over time, currently at 30.9%, and that's partly impacted by a favourable mix, so an increased proportion of higher margin works, particularly in the infrastructure sector, and arguably subdued work in our slightly lower margin work in the residential sector, but also operational performance, good operational performance really right across the business, showing further progression there. Mark's already mentioned the flat EBITDA performance. We've got a relatively small number of non-underlying costs in the P&L. Cost of acquisition, we acquired Albion Drilling at the end of October, and that came with a modest level of legal costs, and as Mark's touched on, managing our cost base. So there has been some continued restructuring to make sure we're the absolute right size as the business and the markets start to come back and recover. So we've cut costs reasonably hard this half, and that sort of changed the run rate from the exit run rate from the previous year. We will need to resource up again as the markets start to come back. In terms of the business structures, the 3 segments that we report against: general piling, specialist piling and rail, and ground engineering services, just touch on these briefly. Clearly in general piling, that sits right across our 3 end markets, and the markets have all been challenging in their own ways. Rock and Alluvium, our acquisition from Galliford Try, sits within this sector, and has suffered as a result of primarily the Building Safety Act. We've got approximately 40 contracts where we're in negotiations with customers, all being held up because of delays to the BSA, and that's about delays to getting planning approval to get on with the work. Rock and Alluvium also have about £10 million worth of work in the order book, and a substantial proportion of that is also being held up by delayed planning. So a real challenge for our industry at the moment, and we're doing what we can to lobby government and get these unlocked. But once they do get unlocked, we'll start to see a real throughput of that work coming back through. So the challenge here is more about delay than a lack of work. But across general piling there, you can see the drop off in revenue has flowed through to reduced operating profit number in the period. Specialist piling and rail, a bit of a mixed bag here. Specialist piling coming back very strongly, certainly towards the end of the first half, and you can see there some positive uptick in the revenues. Rail, Mark's already touched on this, so I won't go into any detail, but we are finally starting to see some revenues coming through, which is a little bit of an upturn in CP7. But the important point here is that we've got a bedrock of work through Transpennine route upgrade, where we're on the framework there, and we're still continuing to do work in the rail station sector, which we've got a long track record of doing. So pleasingly, this is heavily exposed to the infrastructure markets. It's good margin work, it's good specialist skill techniques, and you can see there that with a slight uptick, we've got a healthy return and improvement in our operating profit numbers. Ground engineering services is largely the Smartfoot, so it's our housing business, our housing division, with some work from Strata, which is our ground investigation division. clearly, you won't be a surprise to anyone to see the drop off in revenues half one versus of last year versus this year. Half one last year benefited from some changes to the building regulations, and what we saw in the first quarter of the prior year was a real acceleration of activity in the housing sector, and we benefited from that for 2 to 3 months of the year. Since then, though, since really from August 2023, the market has been very difficult in housing. Much lower volumes. Obviously, this is widely publicised with the house builders, and I suppose the story really is that we're slowly starting to see this come back. I don't think the market's at the level it will be. I think we'll see continued improvement, but we are now seeing much stronger orders. Our order book in housing has gone from 5.4 million at the end of April last year to just over 11 million at the end of December. So much more inquiries coming in, and we've now got a relatively full order book, which will see us right through to the year end. So we expect to operate at close to capacity for the remaining 4 months of the year in our housing division. Strata seeing the impacts of the more challenging market as well, but again, they've got a relatively full order book now to take them through to the end of the year. So a very difficult and challenging first half in that division, resulting in much lower operating profit, but a fairly optimistic outlook both in the housing sector and GI. And GI usually being the precursor to the market improving. So when we start to see an uptick in activity in Strata, usually the piling divisions tend to follow. In terms of the balance sheet, again, relatively self-explanatory here. You can see the upturn in fixed assets, and that's primarily through our continued investment. We're focusing on investing in rigs where we can get high utilization, high return, but also the acquisition of Albion Drilling right at the end of the period, bringing in 2.7 million of assets into fair value. The working capital, we've seen further growth here. Nothing really worrying. I will just note that we've got a delay to the R&D tax credit payment. Very standard at the moment, I think, is that there's a lot of inquiries going on. To give you some comfort on this, we outsource the R&D claim with experts who do this. Do hundreds of claims every year. So this is a standard inquiry, but the return times for HMRC to complete their inquiries is on average 8 months. So that's caused a bit of an upturn in our working capital. About 1.3 to 1.5 million of our working capital is sitting there waiting to be settled. So nothing particularly worrying in working capital. We still do very well with our debt collections. We have very low levels of bad debt. So I think that's all fairly sensible. Net debt has declined, our net funds position has declined, as you can see. Again, of course, we've continued to invest in the fleet. We've continued to invest in M&A, and that's caused some of the cash to be used up over the period. The deferred consideration that remains is the final payment on Rock and Alluvium. That's now been settled post-period end. And then we've got some remaining amounts to be paid on the Albion acquisition, which for cash management purposes, we spread those out over the next 12 months or so. I suppose importantly there's a breakdown of the net funds position. You can see there, cash is sitting reasonably healthy, modest amounts of hire purchase. So we've remained low debt to the end of the half year. And IFRS 16 lease liabilities have stayed broadly the same. But importantly, we still have the 11 million facility with ABN AMRO that's available to give us that headroom that we need. The next slide is just simply the usual cash flow. You can see there, I think I've touched on the key points though, which is, given the market conditions, relatively healthy operating cash flow. The working capital increase I've talked about. You can see the continued investment both in M&A and capital, and of course the dividend payment there. So hopefully that's all fairly self-explanatory bridge.
Thank you, Graham. I'm going to talk now about some of the growth initiatives and answer the question of how do we go from 130 to 140 million up to 200 million over the next 2 or 3 years, which is what our consensus forecast would indicate. And as you'd expect, we've got a plan behind the scenes to do more than that. It won't all come off, of course, but we're still happy with the forecasts that are published. This is a deliberately, slightly opaque comparison of the relative growth rates from a baseline position in FY25 of our key sectors that we've touched on already in some part. And you can see the relative size of those as well in the group. So the first FY25 bar, you can take that as being FY25 revenues, and so circa 130, 140 million, and then the light blue bar on the right accumulates to circa 200 million by FY28, and that's how we get there. And different dynamics in all of those sectors, different speeds and challenges and opportunities. But there's two or three things worth pointing out. First of all, in residential and housing, you can see what an important part of our business this is. You can probably there visualize the delays in the Building Safety Act that we mentioned, and what that might do going from FY26 onwards, because I don't think we'll see too much in the balance of FY25 coming through, unfortunately. And then you can probably also visualize the growth in domestic housing and the smart foot impact of that for new build housing as we expand our capabilities, which we'll need to do to keep pace with what we think the market demand will be. So good solid rate of growth in housing and residential, touching on two of our divisions primarily. The energy sector is growing fastest of all of our sectors from a reasonable base in FY25. We already have 20 million of awards in substations and other non-ASTI related infrastructure in the last 12 months, and we've announced on top of that the wood framework in the last few weeks, and we have two or three others that we expect to put in place behind that. Those start to ramp up very quickly from 2026 onwards. Initially there'll be ground investigation and design, then we go into the full-blown construction. This is why we needed resources in Scotland, because a lot of it starts in the Highlands and then works its way down the east coast as you get into other programs. Water starts from a particularly low base and grows, more than steadily. This is supported by our partnership with Galliford Try and others, where we are being embedded early with unique capabilities to redesign their traditional sort of approach that's been crying out for change and modular approach to foundations. But we have a breadth of capabilities again that works very well in the water sector, and the spend, of course, from AMP7 to AMP8 is significantly increased. And I'm very happy with where we are going into AMP8, which starts in April next year properly. Of course, all the water companies and their contractors now know what they've got to spend and are getting on with allocating the work and starting the priority schemes. Rail is steady growth, and then we forecast, without getting too carried away, that we'll reach a peak in CP7 where perhaps we may be capacity constrained, given that a lot of this work is weekend focused, and there's a limit to how many resources we can put at this unless we see big electrification schemes come through that have midweek working. So high margin, we'll make the most of it. We think we've got plenty of opportunity to continue growth for the next 3 years. Highways is flat. Spend in highways is challenging. We've now seen the completion of our works on the Smart Motorway Alliance, which has been very, very good for us. I'd hope for it to be massively bigger than it has been, of course, but no new ones are being built. But the retrofit programs have gone very well. We've performed excellently, but we finished them. And this now gets replaced by discrete regional projects with our typical tier one partners. Again, Galliford Try features strongly here, and one or two others as well. And we have a good pipeline of those schemes. And then building and industrials is going to grow because of commercial build. We see as interest rates come down, we'll see increased confidence in this area, and industrials, logistics, manufacturing and data centers are all expected to be growth areas, and we've widened our capabilities and partnerships to take more advantage of those going forward, and increase the scale of our precast factory, which will help as well for big sheds. And then I've got a couple of slides that just, I don't need to go through all of these in detail because I think I've probably touched on it, but there you can see a summary of the dynamics in housing, already nearing capacity in Q4 this year, which is interesting. And then we need to expand capacity to keep pace with the opportunities ahead of us. Previously talked about our partnership with M&J Evans, that's starting to yield opportunities to embed with customers a bit earlier, and help us expand into the southwest as well. There are distinct advantages to our system, it's probably worth mentioning, that help with the growth in housing starts and more sites needing to get built faster and opening up work fronts where there's resource shortage in the industry, because of course this is a modular approach that speeds things up. So we do expect SmartFoot to become more popular, in addition to housing growing in terms of volumes, if that makes sense. So we feel like there are good opportunities for us to grow our position as the housing market improves. The energy sector, there's a diagram of all number of different transmission lines and interconnectors, lots and lots of big substations dotted around as well, which is a key area for us where screw-fast is increasingly popular. We've already, we're on several schemes now, and we can see some big frameworks here. We have a £200 million target pipeline. This isn't just everything that we're aware of. This is with customers that we expect to convert some or all of those opportunities in partnership in due course. Whether we have to share them with other partners, because we won't be awarded everything solely ourselves, but it really is a very exciting pipeline of growth for us, and we've got off to a pretty good start with Wood, and that will, we think, with them go into another one, and there were 2 or 3 others like this not far behind, hopefully over the next 6 to 9 months, that we'll be able to announce as well. I've mentioned the acquisition of Albion, which was designed specifically to support us, given that a lot of this work will be initially in the Highlands. In water, again, I've touched on the growth between AMP7 and AMP8, our partnership with Galliford Try. You can see on the right-hand side what a typical water treatment plant looks like, and the modular structures and the different techniques that are needed to deliver a lot of this work during AMP8. And we've got the breadth of skills that help us with that. A lot of this work is early contractor involvement, where we get embedded at an early stage and help redesign the foundation solutions to something that not just suits us, but is more efficient and differentiates us. And those partnerships are, Galliford's a very important one, of course, and it's a key part of their growth. We will do all of their ground engineering work, I hope, in this area, but we have 2 or 3 others that have a similar intent towards us that we expect to make progress with. And in rail, CP7 spend is slightly more biased towards our strengths than CP6. There's a lot more sort of drainage and climate change related infrastructure works that are needed. We've got a good diverse portfolio, including TRU, as Graham mentioned, but also big stations and Canada. The works that we've started so far in this period we're quite happy with. We started our 10-year framework in the southern region with Network Rail, albeit slow. We can see the opportunity, and that's the biggest framework, longest framework we've had ever in the rail sector, and it hasn't really even got properly started yet. In Canada, we're a bit more cautious than perhaps 6 months ago. We've seen further delays to the big major program that we mobilized for, disappointingly. But on the other hand, we've been very successful at securing frameworks direct with Metrolinx for other associated works. So we're kind of we're in a stable but not yet fully profitable position. We're sort of roughly break even, and I wanted to be making a bit of a profit this year, but I don't think I'll be able to do that. But we won't be repeating the scale of the investment losses that we made last year. and we're going to review after this quarter really how the landscape looks, and we'll go from there. So all in all, we're absolutely continue to be very optimistic about the future. Fully appreciate that there's always reasons why things are not moving forward as fast as they should be. We are in a very challenging market right now. I don't think there's any doubt about that. I think we're coming through quite well, if I'm honest with you, and the growth opportunities ahead of us are fantastic. I think we've positioned ourselves very well for those. I've ran through them in enough detail, hopefully, to give you all a good update as to what we're up to. We'll continue to make bolt-on acquisitions where appropriate to help us accelerate things, but we won't be building up significant debt in doing that. We're trying to fund this through the way we structure it and through our own cash reserves. Our order book is already up materially, and we expect to see quite a bit of that delivered in Q4, which is going to help us with the second half weighting that's implied in our confidence that we're going to hit this year's results, and we're certainly confident of hitting our medium-term objectives in the timeframes we've laid out. Thank you very much.
Great. All right. Well, thank you, Mark. Thank you, Graham. In terms of the questions, we have a number of questions, but please do continue to submit your questions using the Q&A tab in the top right-hand corner of your screen. If we could start, Lawson has submitted a couple of questions. His first is, you state that cost savings have been implemented, but admin costs are up 4.5% on the comparative period in line with inflation. So where are the savings?
Yeah, that's a good question. So there's a number of factors at play here. If you compare to the previous half year, you're absolutely correct. But two things happened in the second half of the year which increased our run rate. So if you look at the second half of the previous financial year, you'll see a ramp up in our overhead cost base. One of that was because we acquired Rock and Alluvium and brought in their run rate of overhead costs. And the second part was that we were seeing increased confidence in the market, which pre and post general election, I think was dampened. So if you look at our end of the previous financial year in April, we saw very, very strong ramp up in activity levels. That unfortunately wasn't sustained, and we were gearing up to really go for it. Of course, the market's been very subdued, as you've seen across many of our competitors and our customers. So therefore, what we've done is we've taken steps to reduce that cost base. So if you look at the run rate in the second half of the previous financial year versus the first half, you'll see a relatively healthy reduction, and that's even taking into account the inflationary increases that we've seen. That's reduced our overall cost base. We've continued to do that. We continue to do that even into the second half. So we expect to see some further reductions, but I think that puts us in a much better place for the level of revenue that we're currently delivering.
Super, thank you. And another question for Lawson. Good improvement in specialist piling, but the other two divisions have shown a reduction of 2.8 million in operating profits on a drop in turnover of just 5.8 million. Seems very high. You refer to issues with Strata, but give no quantum or colour. Are these issues ongoing? Are they loss-making? Margin on these two divisions is just 1.9%. Yeah. So could you add some colour to that?
Yeah, look, again, a good question. I think there's a few factors here to mention. One is that, yes, you're absolutely right, a drop-off in operating profit is disappointing, but in a capital-heavy business where we've got fixed overhead costs, a drop-off in revenue can hit the bottom line quite severely. We're not operating at the levels we need to be to deliver those higher returns that we've promised. Now, we think the market's coming back to allow that, and what you'll see is that on relatively modest increases in turnover, you'll see that profit come back relatively quickly. You are right that we note the Strata contract. The reason that we haven't put any quantum to it is it's a challenge that has brought the blended margin down. It is very, very rare for our business to have loss-making contracts. I'm not saying they don't happen, but I can't remember the last time we had a significantly loss-making contract in the business. All that's happened here is we've got a large proportion of our strata business had a decent-sized contract that normally would deliver around 50% gross margin, and in this circumstance has delivered around 20% gross margin. So we were, as a business, disappointed with that performance, but it's brought the blended margin down rather than caused us a major problem for the future. The contract is finished. We're in final account negotiations. We've made sensible provisions in the balance sheet, so I don't think there's any ongoing issues there to talk through.
Okay, and talking on provisions, a question here. Provisions at the 30th of April 24 were over 8 million, but that seems to have reduced to under 2 million at 31st of October 24. Where has this reduction gone?
Yeah, so we've got most of this was in our in the public domain through our RNS releases. This is a legal matter that has been relates to a contract dating back to 2012. It was a insured matter, and therefore the balance sheet was grossed up. So what you would have seen is an increase, a gross up in the balance sheet within our debtors, but also within our provisions, and that was effectively to show the amount that we expected to come in from our insurer and then paid out to the customer. This is a contract at least 12 years ago, delivered well before our time, that we failed to deliver and have been going through the legal challenge ever since. Very pleased to say, and we did put a note out on this, that the matter was closed off. I think it was in May. I need to go back and check the exact date. Within our insurance limit, and is now fully settled. So as a result of that, at the end of the year, at the end of the last financial year, the position was still in play. It wasn't settled until post-year end. We've now netted down the balance sheet, so there's nothing particularly sinister there around the movements in provisions.
Super, thank you. John has a question on the HMRC R&D tax claim. Given the delays in HMRC R&D tax claim receipts, do you foresee any further impact on working capital, and what measures are in place to mitigate such risks?
Well, if working capital in general, no. I think we've got the normal procedures in place that you would expect to have, which is around, debt collection, managing our payment terms, all of that sort of stuff is robust. I think the question is specifically around our R&D position. This is a standard inquiry that HMRC are now becoming far more active in, particularly in the R&D space, and particularly for construction companies. We employ an external expert to do our calculations. They do hundreds of these, or they have done hundreds of these claims. They're a reputable business who specialize in this. We are probably 2/3 of the way through that inquiry. It's not unusual, of course, for HMRC to query taxes, claims, etc. And this is just a standard inquiry rather than focusing on anything that they see as a particular problem. We are working with them to resolve their queries. At the moment, I'm expecting that to be resolved, hopefully in advance of the year end. But normally, you wouldn't expect HMRC, having gone through a query, to then make further inquiries unless they find a problem. We're not aware of any issues that they've found to date, but it is certainly the case that they are being more aggressive in chasing down those customers who are not, those taxpayers who are not necessarily following the due process. But we feel that we have, as I say, we pay a robust fee for a professional service to do this claim for us.
Right. Okay, super. Thank you. Paul asks, I'm slightly puzzled by your confidence in meeting market expectations of 6 million. Your paid for research analyst has cut his estimates to 5.5. He then adds that this downgrade might be temporary, but it's pretty unsatisfactory. What is the number, 6 million or 5.5?
Well, the answer is that the analysts have formed a view. You may not have access to all of the notes. You'll find that Peel Hunt have remained and kept their numbers flat. You'll find that Dowgate, who have initiated, have come in at a slightly lower number, reflecting their assessment of a number of factors, including what the economy is likely to do over the next few months and how swift that recovery will be. Zeus have looked at their numbers and kept those flat for the current year, and our paid for research, as you mentioned there, I think you're referring to Progressive, have taken a slightly more cautious view. So the range at the moment is 5.5 to 6 million in a very difficult market, and I think that they are all taking a sensible view given the uncertainties around the balance of the year. Our confidence is really about future periods, and all the sectors that Mark's just talked through look very positive as we move forward. But there is no doubt that we are suffering from contract delays at the moment, and if they continue, that will cause us a challenge. But as we sit here today, we have got work scheduled and a healthy order book for delivery through to the end of the year.
Super, thank you. On the point of the broker, why did you feel the need to appoint a joint broker?
Yeah, go for it. Yeah.
Well, I think there's a lot of factors here. We've got a number of investors who've been in with us since IPO, and if we're completely honest, the market has been difficult for the last 5 years, and if we're really transparent, the company underperformed post-IPO. And we've got a number of those who are looking at their investment, understandably, of course they would be. And we've had redemptions in the market where shares have become available. And that's just a factor of the market mechanics. And so we've been working very hard as a team to make sure that we firstly work with Peel Hunt to find a home for those shares, people who see the opportunity that Van ELLE has. We've worked very hard on retail, make sure that we've been open through whether it's Mellow presentations or through this forum to present and create that market for our shares. And Dowgate bring a slightly different approach to their looking at investors. And so we felt that a combination of Peel Hunt plus Dowgate for a sensible cost overall, we felt that might drive a better performance. What can I tell you other than at the moment we've got a very full schedule of investor meetings over the next 3 to 4 days, which we have not had for the last 5 years. Generating the level of interest has improved, and I think it'll be a good partnership.
Great, thank you. John asks, if rock and alluvium are not trading very strongly, does that reduce the payments to Galliford Try?
No, it doesn't. It reduces the price that we paid for rock and alluvium was, you may recall, it was a fixed price deal with a deferred element to it. But it is important to note that the price that we paid was not greatly in excess of net asset value. So we felt that the price we were paying, we were effectively paying for the assets that we acquired, which is broadly their rigs, and that really that was really the basis for the deal. Alongside that, obviously, we have a 5-year trading agreement with Galliford Try, and that's delivering healthy revenues over the year. So overall, they are finding life difficult at the moment because of the Building Safety Act, but I think once that unlocks, we'll get back to normalized levels of trading.
Great, thank you. Ben asks, government spending on highways remains below expectations. How does this affect your infrastructure division, and are there alternative projects to offset this slowdown?
Can you find that again? Where's that gone? Yes, well, reference the earlier diagram, we expect highways to be flat rather than a growth area. That's not uncommon amongst peers and customers, and we anticipate that the other sectors mentioned, energy, water, rail, housing, will more than offset the flatness in highways with the growth prospects that we're looking for.
Okay, super, thank you. David asks, do you still get orders related to insurance claims, for example, subsidence landslip claims? If so, do you have any idea of current volumes of this business area within the relevant sector?
I could take that one. I mean, I suppose there is. So typically, we as a business, we are more about new projects than responding to insurance claims. Insurance claims tend to be of a relatively low value, not an area that we focus on as part of our core strategy.
Yeah.
However, do we get to respond to landslip claims? Yes, absolutely. That might be part of highways. It might be part of the rail sector, but on infrastructure, we would respond to those. Not typically linked to an insurance claim there, though. That would be more about just delivering short-term works for to respond to particular issues.
Yeah, that's a good answer. There's a big landslip at the moment on the Manchester Metro that we're looking at, for example, and we get called out to look at landslips in rail all the time as emergency projects. It's very much part of our sort of customer portfolio.
Yeah, super. Thank you. John asks, what is the anticipated impact of the recent budget on the company?
Well, there's two parts to it, really. One is the point that's impacting everybody, which is the NI increase. And of course, for those of you that have followed Van ELLE before, will know that we have a fully employed workforce. That has great advantages, making sure that we have a fully trained workforce. They're part of the team. We know exactly the people that we're putting on jobs. We don't use agency as a matter of course. Of course, that means that we're going to suffer from the national insurance increase, and that is about 900,000 total. Now, we will take steps to mitigate that. Naturally, everyone in our industry is going to be looking at pricing as a result of this. We're also obviously having a look at our cost base, looking at recruitment freeze in place at the moment. Only for key roles would we recruit, and we're having to be sensible around inflationary annual increases. So quite an element of that will be mitigated, but absolutely it's not it's not particularly helpful as we move into FY26. The second part of it, I think, is just the market confidence.
Yeah.
It has taken, the market has taken a dent in confidence since the end of October. I'm sure everyone on this call has read multiple articles around how challenging the markets are post that budget. It was not a business friendly budget. And as a result of that, we've already touched on it, but we've continued to see delays. Customers are just looking at their contracts and pushing them further back down the track, and that has an impact on a subcontractor.
But also, public sector spending has been, obviously held back and is under review. HMRC claims are being delayed, aren't they? There's all sorts of things that we're seeing.
Super. All right. There's a question here from Keith, but it may be slightly difficult to answer. So if it is, do let us know. In each of the sectors that you operate in, what is your position in the list relative to your competitors? Now, I don't know whether that's an easy one to address or not.
No, it probably is quite difficult. But look, Keith, I'm pretty confident that we sit in the top 3. And I'm saying that on a prudent basis in all the sectors that we operate, possibly with the exception of industrial warehouse sheds, where perhaps we would be top 5. But otherwise, I think we're market leaders in a few, not least rail. Top 2 in housing. But yeah, so yeah, top three across the board, and top 5 in warehousing.
Okay, and I guess that plays slightly into a question from Paul, which is your pricing power seems poor. What is your market share, and do you see some scope for price increases as your turnover moves to the targeted 200 million?
Well, we think we have 15% market share. My chief operating officer is also the chair of the Federation of Piling Specialists, and we have a pretty good view of the wider market. The pricing is quite aggressive because there's a long tail of smaller regional piling contractors out there that nip at our heels on in every corner of the country, and too many of our customers unfortunately still purchase on a lowest price wins basis, which, the more enlightened are moving away from that as capacity starts to become a concern. And that's what we're seeing in energy and water. And we do see it in rail quite often. And with some of our customer partnerships, we're not really pricing so competitively. We're involved early, and we're perhaps negotiating work with benchmarking along the way, rather than at a lowest price wins at the 11th hour type thing. So that's how our pricing power will evolve. It's starting to evolve already as capacity starts to concern the upstream customers. They'll move to companies like us that have stronger balance sheets, wider resource capability, more capability to get out of particular technical challenges that come along, or provide alternative solutions, which is really what we're all about.
Great, that's super, thank you. Final question. You sound considerably less confident about operations in Canada than was the case previously. What do you think are the options for the business in Canada?
Okay, well, look, I'm disappointed with delays in Canada. I am, because I've been out there and I've kind of, it is a very, very exciting landscape, but there's quite a lot of politics going on at the minute in Ontario. The options, we've got several options. I'm probably not really feeling like I want to go through those today, but we are going to go through them as a team and come up with the right answer. But we're going to do that, maturely and sensibly over the next few months.
Yeah, super. That's great. Thank you, Mark. Thank you, Graham. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on Van ELLE, please do get in touch via vanelle@walbrookpr.com. Many thanks for attending today's presentation.
Thank you.
Thank you.